Welcome back again, viewers. Over the course of the next half an hour, we are going to dissect the impact of Budget 2025 on Deal Street and the overall investment climate. This is yet another edition of our non-stop live post-budget coverage. We have for you a power-packed panel offering a 360-degree perspective. Raghubir Menon, partner at law firm Shardul Amarchand Mangaldas; Sonia Dasgupta, the MD and CEO Investment Banking at JM Financial; and Rajesh Simhan, partner at Anagram Partners. So we have the M&A and P legal perspective, we have the banker's perspective, and we also have the tax expert's perspective. So let's dive straight in. Raghubir, if I can get you in to the panel. The big takeaway from today's budget as far as proposals on Deal Street are concerned is, of course, the FDI hike in the insurance sector. Now, this is something that has been in the works for a while. We have seen last year, there was a consultation paper released by the Finance Ministry pushing for a hike from 74% to 100%. And then, of course, the economic survey also spoke about the need for greater FDI in the financial services space and also spoke about insurance being an untapped sector. What's your take on this now being formally announced in the budget? And also keep in mind that this is a conditional hike, right? It applies only to those companies which are investing the premiums in India. So what's your take on the conditional hike?
It's an interesting proposal which has come through, Ashwin. I think it is kind of driven at the entire construct of making insurance coverage in 20 odd years from now for the entirety of the country and getting that on board. And for the growth in our insurance market, it will have to be driven by foreign investment. And the Indian insurance market has always been attractive for foreign investors. There have been a number of structured transactions which have happened over the last several years. I think coming to the point, moving it from 74 to 100 is definitely a step in the right direction. The conditionality which has been built in also, I guess, is more coupled with ensuring that there is no cash outflow from the country in terms of the fresh FDI which is brought in and that stays in the country. The real impact, will it drive a number of the existing ventures to move from a 74 to 100% holding, foreign holding, or attract new large players into the market? We'll, I guess, get to see over the next 6 to 9 months. But it is a sector which we do need to focus on. You did mention something very interesting as well. There's been a lot of focus on financial services, etc., and the interplay that regulation has had there with the ease of investment. The budget's not touched upon that as yet, but that is more, let's say, year-on-year policy. So would hope to see some relaxations on that front as well.
Right. Sonia, what do you think will be the response from the foreign insurers? Do you think these overseas JV partners will be tempted to hike their stake? Some of them, of course, would want greater and complete control. In some cases, some of them want to exit. Your preliminary take?
So I think, there have been actually a lot of foreign insurers who've been waiting for this change and who have not entered the country at all because ab initio they wanted to be in control. So there could be, some of them who will definitely look at this extremely positively and rush to enter the country. One of the few countries in the world which is, an island of growth, the demographics, everything very attractive from long-term point of view. And within the existing joint ventures also, I think wherever the foreign partners are more predominant and the domestic ones have not been so active and have largely been there to give them the support of the so-called Indian shareholding, there we will see very quick changes in the foreign insurers taking over close to 100%.
Right. Rajesh, what are the kind of conditionalities which you think the government needs to keep in mind while rolling out this proposal?
So, Ashwin, very clearly right now what the government seems to have indicated is that they have put in language saying that the premium itself will not move out of the country. Obviously, I think from a broader FDI point and from a broader macro perspective, because the government's always looked at insurance as a sensitive sector, So they have been careful in terms of ensuring that there is proper capital adequacies at all points in time. So the Indian insured are not able to enforce at a later point in time. So that's where I think most of the checks and balances are going to be on.
Right. So let's wait and watch to see what the Bupas and the alliances of the world do and how they react in the days ahead. Let's shift focus now to another key proposal that came in the budget, and this was relating to mergers. This will definitely be music to the ears of all those deal makers who are complaining about really long deal approval timelines. And this one has to do with the requirements and approvals for speedier approvals of mergers. Now that FM Nirmala Sitharaman said will be rationalized, and the scope for fast-tracking mergers will also be widened. Raghubir, correct me if I'm wrong, but currently, as we look at the regime right now, this fast-track approval is only applicable in the case of a few companies, right? Maybe small companies, and also perhaps those mergers involving wholly owned subsidiaries and holding companies. Now, taking a cue from what the FM said, if one way to sort of expand the scope to new scenarios, let's say mirror image demergers, let's say intra-group restructurings, that would be a clear boost, right? Because that would lead to speedier deal approvals and perhaps also declog an already choked up NCLT.
It's a very good point, Ashwin. And I'm going to take a step back and let's address your question first in terms of what is the universe that it could be expanded to. At the moment, because of nuances in wording, demergers or arrangements or reconstructions are not picked up technically. So that clarity can be brought about. Till date, what you see is that in most cases where the fast-track merger route is utilized, it's in terms of VOS mergers into parents, wholly owned subsidiaries merging into their parents. Over and above what was mentioned in the budget, there is another aspect. India is seeing a lot of internalization structures at the moment, where foreign companies are merging into Indian companies. And it's all part and parcel of, if I term it very loosely, the ghar wapsi which is happening, and most people wanting to access now the Indian capital market. So if a fast-track merger could actually expand to pick up foreign into Indian mergers, for which we are now currently going through the NCLT process, that also would be a very big boost. However, the word of caution which I'm going to build in here, Ashwin, is that, look, we've done a number of fast-track mergers over the last several years. Changing the law is a step in the right direction, but what we also need to change is the nimbleness on the ground. It's not as if a fast-track merger gets done in 1 month versus an NCLT process, which can take anywhere between 8 to 12 months. The procedure on ground tends to be fairly pedantic and bureaucratic, and we need to be able to cut through that slack as well. And that's when we'll see the real benefit in terms of deal making, because it just opens up another avenue which is not available today for corporate India in terms of deal making.
Sure, you raise a very important point, Raghubir, because there definitely is the need for more manpower as far as the NCLT benches is concerned. The more manpower there is, the more cases can be taken up and perhaps cleared. Sonia, your take on this proposal of fast-tracking mergers? What's your take on this move by the FM?
I think this is really music to the ears of all deal makers. Not only does it help bring in a lot of efficiencies, because sometimes by the time the approvals come, the dynamics of the market itself have changed. And simple things like you said, mirror image demergers sometimes are the need of the hour to improve capital allocation, to have pure play companies in certain kind of sectors. When a conglomerate wants to, unlock value for shareholders. So not having it facilitated in a time-bound manner, sometimes just, it loses the charm of even doing that entire restructuring. So I think, like Raghubir mentioned, the devil is actually in the actual implementation of this going through. So the intent is fabulous. We really welcome it. And all the M&As will get a great spur. I think it's also in the right direction. This has been a demand from the entire capital market community to the FM for a long
That's
time,
right.
and we really welcome this move.
So it's a clear thumbs up from both Raghubir and Sonia on our panel. One must keep in mind that, at the end of the day, deal approvals are really important within the envisaged timeline, because one doesn't want to be in a scenario wherein one lands up in a spot wherein, the reasons that originally existed for the deal or the original market conditions are no longer there. That could be very tricky for both the buyer and the seller. The next question is on the tax front, and Rajesh, you're the right person to address this. And this is the relief that has come in for sovereign wealth funds as well as pension funds. And this is a scheme, a tax exemption scheme relating to their investments in the infrastructure sector. Now, that was scheduled to end by March 31st, 2025. That's been extended for a period of about 5 years till 2030. How much of a boost is it for this big pocket of investors? Because sovereign wealth funds and pension funds are looking at India in an increasingly aggressive way. And they are picking up stakes, both minority, they're also considering majority acquisitions. So how do you think this decision will influence their deal strategy in the days to come? And which pockets in infrastructure do you think they will warm up to?
So I think there are a couple of points there. One, I think while everyone saw that there was a sunset clause in terms of investments made before March 2025, I think there was an expectation that it would actually get extended, and rightfully so, because the sovereign wealth funds or pension funds are effectively long-term capital, and that's something, especially when we are talking about the infrastructure sector, where you tend to have longer gestation periods and you tend to have longer exit tenure. You do want investors who have a long-term view of the economy coming in. And across, even when you see other jurisdictions, most jurisdictions do tend to provide tax breaks to sovereign wealth funds or to pension funds. So from that perspective, I think it's a welcome move. You will see the investor interest continuing in the infrastructure sector. If you see the deal making over the last 24 months, you have seen that there have been a lot of activity from sovereign wealth funds in the infrastructure sector, be it roads or be it renewables. And even looking at the government's own plan in terms of infrastructure spending over the next 5 to 6 years, that is definitely one pool of capital that they do want to ensure gets tapped properly in terms of investments. So at least all in all, I think from both infrastructure sector as well as from the sovereign wealth funds and pension funds, I think it's just getting that clarity and having it out of the way and having a good 5-year horizon in terms of investment activity just provides a bit more certainty rather than doing it on an annual extension approach.
Right. So at one shot, they've sort of extended it for 5 years, and so therefore one doesn't need to keep looking out for it in the next budget. Fair point over there, Rajesh. In fact, UAE and Saudi Arabia, they have committed $75 billion and $100 billion of investments in India. Sovereign wealth funds and pension funds are a very, very important class of investors. In some deal scenarios, as all three of you would know, they are in fact competing with the bulge bracket global private equity funds. So therefore, good news as far as they are concerned. Raghubir, now let's shift focus to BITs, or bilateral investment treaties. And those are, of course, pacts which lay down the terms and conditions under which you invest in a country and vice versa. The FM said that they're going to revamp BITs and perhaps make it more investment friendly. Now, in the past, BITs have been the bone of contention when it comes to litigation. What do you think are some of the safeguards or aspects that the government needs to keep in mind so that at one end, the sovereign interest is protected, and at the other end, they also ensure that there is no unnecessary litigation?
See, it's a very interesting question, Ashwin. Frankly, if you ask me, the issue has never been with the BITs themselves, and it'll be good to see what the government is proposing in terms of, say, streamlining or making them more investor friendly. But the issue has been more in terms of some of the other laws which have been passed in the country. So, for example, what we refer to as the Vodafone taxation issue. A lot of those kind of legislations have resulted in BIT disputes, which India has become part and parcel of. I think simplicity in legislation and the fact that there is going to be a new direct tax code, we need to see what the structural changes which are being proposed in terms of that, etc., come about. That will feed into the whole story of BIT is potentially becoming a positive tool rather than being viewed negatively like it was in the past.
Right. Sonia, how would you respond to this move by the government? We don't know the fine print as yet, but the intention seems to be positive. Make the BITs more investor friendly.
I think anything that gives an overall feeling that there is continuity, certainty, clarity always helps deals, right? No foreigner wants to come into a country with one set of rules and when they are exiting have another set of rules thrown at them, because people plan for the long term. So to have continuity and certainty always helps. And I think we as a nation need a lot of investments. So we should nudge both the private sector, whether it's domestic or international, to make investments for the long haul. And any irritant which comes in the way, especially in terms of taxation, should be something which is clear and consistently followed, so that people can focus on business rather than get distracted with the noises around what is the taxation when they enter versus exit. So anything that gives clarity and certainty always helps a country to become an attractive destination for investment.
All right, clarity and certainty, those are the key words, and perhaps that's why the Finance Ministry is moving in this direction. Rajesh, now let's turn the lens on startups. And every budget, at least the past few years, there's been a lot of impetus on startups. This time around, they've announced another fund of funds for startups with an extended scope and an additional allocation of 10,000 crore rupees. We had something similar in last year's budget as well. Give us a sense of how this will influence, entrepreneurial confidence on the ground, and what kind of an impact will it have on deal activity in the startup space. A lot of VC firms, have made a beeline for this space in the last few years, and in some cases, even some of the bigger private equity funds.
So I think that when you think about what the government has actually been doing, what most people don't realize is that SIDBI, which is the government entity, is actually a LP in almost a substantial number of Indian VC players. So, and what you're really looking for is a multiplier effect. So, a 10,000 crore from the government effectively translates into, because the Indian funds will then have to raise other LP capital, and then that goes into the startup. So, what you're really looking at is a multiplier effect. So a 10,000 crore from the government effectively means that you're potentially creating a pool of capital which is in excess of 50,000 crores over a period of time that can get deployed into startups. So from that perspective, again, it's something that is necessary purely because you do want to build in a good set of Indian GP asset management and not just have foreign investment coming in respect of funding startups. So I think that's definitely one aspect which we will see the multiplier effect play over a period of time. And apart from that, obviously, you also have the period of time. And again, they've taken a long-term view even in case of startups in terms of what are the periods where they can claim the tax holiday. They have extended it. So I think, and similarly, they have tried to put in certain exemptions or put in certain certainty, if I would put it that way, in respect of entities which are into manufacturing. So I think what the government has been focused on, when I look at it, is to sort of see how do we sort of ensure that there is enough manufacturing capability? How do we ensure that there are enough startups that can be funded? And I think it all comes back to ensuring that the number of people who are graduating and who are coming into the sector for work, all of them can be taken care of. I think all in all, I think that's actually a good move from the government.
Yeah, you summed it really well. Raghubir, now let's look at ease of doing business. So there's, of course, the impact on Deal Street. There's, of course, improving the investor environment. And, of course, ease of doing business is also going to make things easier for corporates and as well as overseas investors. So one very interesting introduction is the High-Level Committee for Regulatory Reforms. Now, this has been set up specifically for a review of all non-financial sector regulations, certifications, licenses and permissions. Now, that opens the floodgates for the examination of several regulations and rules, right? But what do you think was the FM's intent in terms of pushing for this move?
So, Ashwin, take it back a few years, and you remember there was this whole talk about single window clearances for businesses investing in India from abroad, or even for Indian corporates accessing or looking to set up new ventures, etc. It went a little part of the way then in fixing some of the issues which we have always had around bureaucracy in India. But my sense is this is a much farther reaching kind of initiative. Again, the devil will be in the minutiae and in the detail when it comes through. But there is the ability now to look at a whole host of legislation, a whole host of changes which could be brought about in terms of just something as simple as your day-to-day compliance, so say from a labor perspective, labor code. So many changes which would just result in businesses having to spend less time, energy, headspace on just mundane compliances. But it's a very, very kind of open this thing she's given herself, and it's a mandate that she's given herself to be able to reform a number of aspects.
Right. Sonia, what about capital market reforms, right? We are coming, this budget is in the backdrop of a spectacular year last year for IPOs, right? The economic survey also spoke about it. There's geopolitical uncertainty, there are choppy markets, but lo and behold, there are big IPOs being launched, pitches are being held, bankers like you are getting increasingly busy. What's your take on the capital market reforms as far as this budget is concerned? Do you think perhaps more attention could have been paid?
I think the biggest benefit of this budget has been the clear focus on fiscal discipline, right? So, and the capital markets really don't want too much of tinkering every year. So, as long as there is, I repeat my earlier things, certainty and continuity, clear direction, which way we are going, I think they are happy with that. We don't need to fix anything that is not broken. Things are going fine, and I think they have been left alone to that. That's a great positive. The focus on fiscal discipline, along with spurring growth and making sure that we are focused as a nation on building capability, capacity, consumption, is the biggest positive for the capital markets. As long as we get a boost to consumption, which was something which was lacking, it will have a spiraling effect on growth. We focus on making sure we have a youth which is educated, and the gig economy which has well taken care of. I think these are the main things that has been focus of the budget, and most importantly, like you just asked in your earlier question, ease of doing business. As long as you unshackle the long overdue burden on businesses, that itself will be a great positive sentiment for doing business, and that capital market will just reflect the happiness and ease of doing business.
Right. Rajesh, I want your take on this, because this seems to be really good news for all investment funds, right? This is a specific proposal that our team detected. Now, according to this, any security held by an investment fund will be treated as a capital asset, and therefore any income arising out of it will be treated as capital gains and not business income. Correct me if I'm wrong, but this will put an end to a lot of litigation that was there between the SECs and the taxpayers, right? Good news for all the funds.
Let me try and address it differently. I think a lot of the changes, including The one in respect of treating all investments as being in the nature of capital assets. It is more towards ensuring that the cost of doing business is reduced, because nobody wants to fight litigations where you know that you're going to get a favorable outcome, but you're going to be spending 6 years fighting the battle. And that is where really the focus has been and ought to be, which is that as long as you're bringing in certainty on issues which are really where mostly settled, but there are still enough outlier cases that it ends up becoming a risk issue that everyone has to deal with, or potentially it goes into a litigation which people have to deal with for significant degree of time. So I think that's the way I do believe that the approach has been, which is that how do I ease up the cost and time when it comes to doing business. And something like, bringing in certainty in respect of AIF taxation and treating the investments that they make all as capital assets is just bringing in certainty so that there is no further litigation that's going to come in on this issue.
Right. Sonia, a very interesting proposal that was made by the FM also was to sort of boost, competition between states in terms of who will attract more investments, who will woo the bigger investors. And this is the introduction of an investment friendliness index of states. Quite creative. What's your take on this? Because this will ensure that, the Maharashtras, the Tamil Nadus, the Gujarats of the world, will be paying more attention in terms of getting ranked high on this index.
I think it's a brilliant move because, there could be a lot of initiatives given, our federal democracy. There are a lot of things that the center may want, but it gets stuck at many state levels. I think most of the states are anyway up the curve on competing with each other to attract investments, whether it is in domestic industry or foreign investors. But I think having this kind of index will clearly up the ante, and it will be very transparent for everyone to really see. It cannot be any self-proclaimed winners. It will be very clear who's really implementing on the ground investment-friendly policies. And I think it will be a great fillip for the nation as a whole. So we really, really welcome this. I think it's a brilliant idea.
Right. Raghubir, one quick question on the government front, the disinvestment front, right? The last few budgets have been rather silent on it. This time around, they've announced a second asset monetization plan. And that's for the period 2025 to 2030. The plan is to generate 10 lakh crores by selling, one may call, family silver of the government or the Sarkari assets, and then take those investments and plow them back into the infrastructure sector. Very quickly, it's time now for closing comments. But before we go to closing comments, Raghubir, what are some of the safeguards that the government should keep in mind to ensure that, these plans are of course announced, but, they're executed efficiently and there's no inordinate delay?
There's two parts to this. It just boils down to government willingness. Ashwin, I started my career as a very young lawyer with the first 3 or 4 M&A transactions which I worked on were divestments. IBP, you had VSNL, that whole series of divestments which was happening between 2001 to 2003, 2000 to 2004. After that, in the last few years, the government has looked at divestments. They've looked at Container Corp. They've looked at a number of situations where processes have started but then stalled. Now, what we need to address now is start a process, keep it moving, don't let it stall, let it keep going on very, very smoothly, and just build in the appropriate checks and balances and bring the right advisors on board. The issue which has often happened in the past is what the government is wanting to do versus the path they wish to follow has not always matched out, especially in the last couple of years.
Sure. Rajesh, as well as Sonia, 10 seconds. One big miss from this time's budget. Very quickly, we have to wrap up the show.
I wouldn't say that they've missed anything, though I think I look at this budget as a budget in transition, because what the government has actually announced is that they're going to bring in a new income tax bill which supposedly simplifies everything. So I think the real devil in the details will be when the income tax bill is placed in the parliament next week, and to see whether the track which they have followed till now to sort of say that there is going to be ease in doing business, whether that follows through in the new income tax bill.
Right. It's time now to wrap up the show. On that note, thank you so much for tuning in and listening to this very special dissection of the budget's impact on Deal Street and the investment climate. Stay tuned to Money Control for more news, views, and updates.